the slide looks extremely ambitious. Someone puts up a title, The Future of Professional Accounting, and I will try to say something useful, but as my first slide will say, I don't have a crystal ball. And I show these slides to my wife. If you said, that sounds like you actually have a crystal ball. I said, yeah, I do, but it doesn't work, right? And so we all have a crystal ball. And so I will kind of look at some things that I only really agreed to do this when Len contacted me, as I say, because I was at the time doing a book review for this thing, which some of you may have heard of or probably not. It just came out. You can get it on Amazon now. It's The Big Four, The Curious Past and Perilous Future of the Global Accounting Monopoly. Well, as soon as you read the title, you kind of notice that there's probably a bit of a pejorative slant to it, right? Because I don't know that those of you who work for the Big Four, and I'm sure there are many, view yourselves as a global monopoly, but the authors are Ian Gow and Stuart Kells. I'd never heard of these people. Ian Gow turns out is a professor at the University of Melbourne. He was formerly a professor at Harvard, and he heads some Australian institute on corporate governance. Stuart Kells is a writer. So I was asked to do this for the Accounting Review, and I was working on it. And I thought, well, okay, I'll sort of take whatever I pick up here and sort of try to pass it along and see if it makes sense, and then add my own thoughts to it. That's basically what I've done. Oh, by the way, I did pan this work, the book review will come out in the Accounting Review at some point. I did actually pan it, and I panned it largely because these authors were quite dismissive of academic research and auditing. They in fact referred to my colleagues and I as idiot savants, and I thought, well, that's this is not a good way to start, right? So,
unconscious bias.
Yeah, there was some real bias there, so I guess it stuck with me through my whole review process. But anyway, that review will come out in the Accounting Review at some point.
You're just skeptical.
Huh?
You're just skeptical.
Yeah. Hey, so let me start with Gow and Kells then. This is, I mean, they mostly talk about sort of the history of the Big Four. It's really focused on the Big Four and auditing. And there's a lot of background in there, and there's a lot of history, and some of it is quite entertaining. For example, they liken the organizational structure of the Big Four to the mafia, in the sense that the juniors have to generate a lot of cash and pass it up to the, I guess, the dons, right, who are the partners. And you know, again, you say, you know, is this really quite a good model of the way the Big Four work? Maybe in some way, but maybe not entirely. So when you get towards the end of the book, I picked up just some of the things they think about of the future. And of course, as everyone else these days, and many people here, they talk about digital disruption, right? And all of the buzzwords, AI and big data, blockchain, and so forth, and so on and so on. And those things, what makes those things, I guess, important to us is those really are not things that auditing firms, accounting firms, public accounting firms have really dealt with. I mean, it's an IT, these are IT things, right? And so, you know, is this really a domain that where public accounting actually fits in? The second point they make is the structure of the public accounting firms, and this is, you know, I think largely correct. They liken the Big Four to franchises. Certainly they're national franchises. I mean, all the four firms advertise themselves as being global, but we know that they're really not. I mean, they're really national partnerships, which are quite independent. And that does create difficulties. I mean, there may create difficulties in raising capital, and to the extent you need a lot of capital to do a lot of these sort of IT capital investments, that may be a problem. There are issues with standards. I mean, how do you coerce people to go ahead and do what the center wishes to actually have you do? They mentioned distribution of fees. I have no personal knowledge of that, but I can see that could be a problem. If you have a multinational engagement, how do we actually allocate the revenues and the costs and the profits of those engagements to international members who are all contributing? And then, of course, they raise the question of innovation. Can you actually innovate? They have a quite interesting discussion of the Big Four home, the head offices, and what are they really? I mean, are they truly head offices in the sense that a head office of a corporation would be, or are they something else? And they come on the side of something else. They're more almost as window dressing, at least in the opinions of these authors. So, okay, those are potentially valid points. I thought the next bullet would get people is who was in the Big Four? Well, they kind of liken the notion that you have this partnership-driven model. Who does this attract? And I don't think it's totally inconsistent with some things, Kareem, that you said, that, who comes through there are maybe brilliant people, but who stays there. And others have mentioned this as not necessarily the same subset. It's some subset, not necessarily the same group. They use the term average minds from average schools. That may be a bit more pejorative than we'd like, but maybe there is some truth to that. Who knows? And then there's a point, and this is kind of a more subtle point, and that is the question of surviving in an environment where there's a lot of uncertainty. Are the big four, that's the folks in this group, but and more generally auditors, are they good at dealing with uncertainty? And I guess one could argue that maybe they're not, right? We know that there have been a bunch of failures. I just listed some. Laventhal and Horwath, Arthur Young really didn't fail, but they came close, or they ended up in Ernst, of course. Arthur Andersen, which did fail. And then I just noted that the thought of self-insurance. I mean, we know the big four firms are basically self-insured against legal liability. I remember years and years ago when I was working on my thesis, I actually did an interview with a person from Chubb because I was interested in how insurance was being written for public accountants at Chubb, the insurance company. And basically at that time they were still providing insurance to the big four. And essentially I remember this guy saying, all we look at is the size of the clients, and essentially we're making them a loan. And if we'll charge a premium this year based on some reasonable number. Hey, next year if we take hits, we'll charge it back. So it's really just a lending. It's not really insurance. It's really almost like a lending operation. And of course, then they got out of the business. You can't really buy that kind of insurance anymore. So, this failure of firms in the face of this sort of difficulty of pricing risk. So the insurers had a lot of difficulty pricing risk. I would guess that the accounting firms themselves are not that great at it, and we can list cases where there's some demises that you could at least argue were failure to price risk. So I think for those kind of comments, you get the picture, what's in Gow and Keld anyway, and that is that the future looks fairly bleak for the big four firms at least, and maybe it is, right? I don't really know. I mean, my crystal ball starts fading a bit. But I thought, well, okay, I don't want to just say that. That's not very helpful. What struck me that's from a research side, now the rest of my comments are really addressed from the academic to research side. I don't know that we really have come to grips as academics with what's going on in terms of these investments in technology and other things, and thought about auditing as a capital-intensive operation. I mean, we essentially, and I've done a lot of this over many, many years, and many others in the room have as well, we think about auditing, and I think most of you probably do, as a labor-intensive operation, right? And a lot of times that's all we think about, and say basically it's labor, and so I'll come in a minute the way we kind of conceptualize it. So when we introduce a significant amount of capital into that equation, well, that changes the game, I think, quite a bit, actually. And what the implications are, just taking our I took my Econ 101 book out, sort of, and said, well, what the implications are of this, that I don't think we've necessarily given a lot of thought to. Well, not entirely. I have, actually. So I want a little bit of I here. I actually been working on this notion of, the thought came to me actually from one of my PhD students, Louis-Philippe Serrois, who is now at Laval. So he was a UBC PhD student. I remember him walking to my office. He wanted to work on something. And Louis-Philippe, I believe, had worked at Deloitte's. And he said, "Lo, all of the research papers that we've talked about basically do talk about auditing as labor-intensive production. I believe that capital is already important." And I said, well, okay, maybe it is, maybe it's not. I was skeptical. So I said, go ahead and go to the IO literature and tell me what you find, and let's go ahead and work on this. And so we, in fact, did a thesis. And the paper is this first one mentioned, Auditor Size and Audit Quality Revisited, the Importance of Audit Technology. That's sitting on SSRN, for those who are interested. It's actually downloaded thousands of times, so I guess it's been fairly popular. Unfortunately, it was never published except in French. So if you're good at French, you could read it in a French auditing journal. We couldn't really get it into the English language journals. And then there's a working paper I've been working on with another two PhD students, Tracy Wu and Mike Stein. Mike Stein being, of course, an old friend of mine that goes back many, many years. And we have the working paper on fixed cost audit production and audit markets. That's currently sitting in the accounting review, but under review, so it's still not published. So anyway, So here's some thoughts on sort of new production. So what we've done in the past, essentially, is to look at auditing from an audit research side, and what we characterize you, to the extent you're in practice, essentially as having a cost function with two components, right? A labor cost component and an expected loss component, and the sum of those things becomes the audit cost. The capital part we basically ignored, right? And that may or may not have implications, depends what you're doing, right? And so I was thinking when you were Kareem, talking about low, of course, Canadian audit fees, you can explain that by saying, well, low Canadian audit fees are a result of low expected losses, right? So if you have a sort of a weak legal system, then you expect to have lower costs, lower expected losses, low fees. I mean, that's kind of the equilibrium in that kind of a system. So it's not utterly unexplainable. But we have basically looked at firms as having these two cost components. The capital investments, probably people either don't think they're very large, or if they're large, they're sunk and I can ignore them anyway. Well, you can't ignore them if they're sunk. If you're doing some things, you can look at a certain firm and say, well, this is just an underlying capital, and I'll look at the labor usage given that capital. But when you start making comparisons across firms, that may become a problem, right? And there have been papers, I've done some, where people have used the labor hours expended by audit firms as a proxy measure of audit quality, right? And if you go across firms, that labor hour proxy is great. If it's a labor intensive, entirely labor production, it's not a good proxy for quality if it's capital is involved, right? And there have been papers which have looked at, for example, KPMG audit work over time, published in the Journal of Accounting Research. So going back from the 90s to the mid-2000s, it wasn't done by me, but comparing then KPMG over time, if capital is constant, that's great. But if they're not constant, it doesn't really work, right? And so that becomes a problem. We haven't really thought about this notion of the production function. You know, what is the production function of auditing, really? I mean, go back to your Econ 101 book and say, well, you know, we think of production functions, right? So what kind of production function do we have? I mean, I've done a little bit of work on it, but it's typically been labor and mixtures of different classes of labor. Right? So is it a partner, is it a manager, is it a senior, is it a junior? How do those mix in? But really, the capital part has not been there, right? And so that's kind of something you think about. And we've also done audit costs and basically analyzed audits on an audit by audit basis. A lot of research talks about a representative audit, a typical audit, right? Well, what's wrong with that stuff? Well, if you go and recognize the importance of capital, right? You have to look at things not just as audit by audit, but jointly, basically in a portfolio. So certainly, to make an investment decision, you have to think of your portfolio of clients. That's obvious, right? To think about using those investments, that capital for engagements, you have to think about all of your audits. If in fact this thing is capital, if it's constrained, capacity constrained, right? So you can't just think about things individually, and looking things in a portfolio is hard. Quite honestly, it's very hard. Mathematically, if you have different audits with different characteristics and trying to optimize something in that context is tough, if not impossible, right? You may have to do some simulation or something. You may not be able to formally do it. What happens when you have capital-intensive operations, the whole operation changes. You go more to like an airline model, right? And so if you have lots and lots of capital, relatively less labor, you get a lot more variability of profits, right, as a function of volume, right? And you now have sort of a situation where pricing issues become difficult. You can think of the airlines doing marginal cost pricing. If you do too much marginal cost pricing, you basically fail, right? Because you're not never covering all of your costs. So that becomes an issue. How you think about capital, I mean, I've thought about it in terms of efficiency, essentially. I think it's a good way to characterize it. If you do think of production function of auditing, capital probably improves efficiency. Well, that itself has implications. If you have efficiency improving investments, then essentially you're talking about scale economies, right? Classical scale economies. And what will happen with scale economies? Well, if those investments keep working that way, improving efficiency, essentially you can drive everybody out of business except the natural monopolist. So the one firm place, the equilibrium, or you have similar firms, right? A set of similar firms. And maybe that is indeed what we have already, that you have a set of firms that coexist who make investments like the big four. Maybe yes, maybe no. But if those efficiencies still are there, then there's nothing that stops them from continuing on, essentially, until we get to one firm. So what happens with capital investments is you get barriers to entry, right, which tends to separate firms, right? It becomes different. The Big Four look different from the non-Big Four. That's already the case, right? And what happens with efficiency improving investments, essentially your average costs fall, and so you can start undercutting people, right? And so you get implications for, can in fact these or the firms that don't invest enough, can they compete? And the simple answer is they cannot, right? So we know the EU has been pushing small firms to be more involved in audits, get away from the Big Four sort of oligopoly. That's not going to work. If you have efficiency improving investments that are important, it just simply cannot work, right? And so that becomes basically futile, right? Some other things, I'm almost done, right? So some other things. So one of the things about investments is, and if you think about them nationally and the fact that we have national partnerships, kind of a truism in economics is that the viable investments are limited by the size of the market, right? So in a big market, investments can be viable. In a small market, they're not viable. And so what does this imply? Well, how are those investments made? If we go back to the accounting firms, if we share those investments across countries, across these franchised partnerships, maybe. If we keep them jealously to ourselves, and I really don't know how the firms are in that respect, if we keep it jealousy to ourselves, well then essentially you have situations where you can never hope to equalize audit quality across markets, right? Because those investments will be specific to individual markets. Large markets, you will make those investments. Small markets, you won't be able to make those investments. And of course, that's already true, right? I don't know what people in the room think, but audit quality, even take one of the Big Four firms, is not the same across the world. We know that, right? There's lots of research, not lots, there's research which shows that. So audit quality tends to be the highest in the United States. Tends to be lower in the Commonwealth countries, tends to be lower still when you go to places around the world where there isn't a lot of legal liability, right? And so that's exactly what you find. So if you want to equalize audit quality by, let's say, imposing uniform standards, a bit like the previous problem, good luck, right? Because it's like making small firms competitive. Can you have uniform standards when the world is not uniform? Good question. The simple answer probably to that is no, you can't really. They won't work. I mean, you can have standards because we have them, right? I mean, in fact, Minley and I have a paper with Ping Chang on auditing standards around the world. You can have uniform standards around the world, but will they work? Well, some places they don't exist, like in the U.S., which doesn't subscribe to international standards. Some places, like China, they exist, but are they in fact adhered to? That's a good question. Maybe yes, maybe no, right? Okay, a couple more thoughts on them. So, okay, and that's it. Last one, actually. So, where does all of this go, huh? And this is where I asked Len maybe to be last, but I guess he didn't want to be last because it seems pretty depressing. Maybe what happens from all of this is we head into a single, efficient, global auditing supplier. And then the big question, of course, is who is that?